Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'll be taking a deep dive into the Iron Condor option trading strategy. And this is going to be a directionally neutral option selling strategy that can quite literally allow you to make money off a stock simply bouncing around in a range and just going sideways. And moreover, it will give you great control over the risk you're taking, in addition to giving you a high probability of actually turning a profit on the trade. And if this stuff sounds interesting to you, then please do me a favor and hit the like button on this video and subscribe to my channel. I would greatly appreciate it. And quickly before getting started here, as always, if you would like to take some in-depth classes on options trading, and stock market investing, then check out my courses on SKILLSHARE. I've been teaching on that platform for well over a year at this point. And in case you aren't aware, SKILLSHARE is a lot like YouTube, except the content on that platform is geared solely towards the purpose of education in the form of online classes. And in my classes, you will see a lot of the detailed research that I have done using real stock market data with spreadsheets and graphs and even computer programs that I have written to help simulate and prove the concepts that I am teaching. And I've dropped some links to some of the more introductory courses of mine in the description of this video below. Now, you will need a premium membership with the SKILLSHARE platform if you do want to watch my courses, but if you do sign up for that membership using the links provided in the description of this video, you'll get an absolutely free 2-week trial. And during that time, you can watch all my courses on SKILLSHARE absolutely for free. And then once your trial is over, it will only cost you a few dollars a month to maintain your membership, and you'll gain access to all the future courses that I have planned going forward, in addition to all the other classes that are on SKILLSHARE too. And if you decide it's not for you, no worries, you can cancel before your trial is over and you won't lose a dime. But again, if you are interested, then check out those links below and join the thousands of other students that have already taken my classes. And so with that being said, we're going to jump over to my trading platform now and we'll get things started. Okay, welcome to my trading platform here, and as usual, I have a chart already pulled up. This is a 1-year price action chart of QQQ, and this is an ETF that just tracks the NASDAQ index. And so this is the ETF I'll be using to demonstrate how you might want to take advantage of the Iron Condor strategy. And so the Iron Condor is a directionally neutral strategy. So ideally, we want QQQ here to just kind of bounce around in a nice range over the next few weeks. And as you can see right here, we are currently going through a pretty significant market correction in the NASDAQ. And of course, this could go a lot lower. It could bounce back and just continue higher. But if your assumption is, at least for the short term, the NASDAQ might recover a little bit and just kind of bounce around in a range for a while, then the Iron Condor strategy will be a great selection to use. And for some of you watching this video, if you are brand new to the concept of option selling as a core strategy, then the Iron Condor might be a bit of an unusual strategy because we are quite literally trying to make money off of this stock going absolutely nowhere in price. Right? As long as QQQ just kind of stays in a nice tight range and it doesn't go too high or too low, you can actually make a nice profit on that. And so specifically, the Iron Condor is a bit more of a complex strategy in terms of the actual components that comprise it. And so in particular, the Iron Condor is going to require you to be selling and buying a total of 4 contracts. So we're going to sell an out-of-the-money put option and also sell an out-of-the-money call option. And then on top of that, we're also going to buy an even further out-of-the-money put option and also buy an even further out-of-the-money call option. So 2 options we're going to sell, 2 options we're going to buy. And this is all done at the same time when you place the order. So now for an example, let's go to the Trade tab now. And this is the option chain for QQQ. And so let's take a look at the April expiration cycle. These options expire in 41 days from today. And let me scroll down a little bit. So as usual, on the left-hand side here, these are all the call options. On the right-hand side, these are all the put options. And down the middle here, these are all the different strike prices that you can choose for all of these option contracts. And also you can see up here, this is the current trading price of QQQ. As of the market close on Friday, the price of this ETF is $308.68. And so like I said, what we're going to do here is we're first going to sell an out-of-the-money call option. So this call option is going to have a strike that is greater than the current trading price of QQQ. So for me, if I was putting on an Iron Condor on this ETF, for the call option that I would want to sell, I would probably choose something around the 330 strike. So this would be the call option that I would choose to sell. And then at the same time, I would also buy probably the 335 strike call option. So this one's even further out of the money than the option that we're selling. And then for the put options now, same kind of concept. We're going to sell an out of the money put option. So I would probably choose the 285 strike put and then also buy the 280 strike put. So let me go ahead and set up the actual order now so you can see how this looks. So I'm going to right click on the 330 strike call option and go to sell and then go to Iron Condor. And that brings up the order here. So you can see we're going to sell one contract, April expiration, call option with a 330 strike. Then we're also going to buy a call option with the same expiration, and it's going to be the 335 strike. And then we're going to sell one contract of a put option, and that's going to have the 285 strike, which is right here. And then lastly, we're also going to buy a put option with a strike of 280. So that's going to be right here. And so now that we have all of our strikes selected, you can take a look at the credit now that we're going to receive. This is the amount of money you're going to take in for selling this Iron Condor. And this number is quoted on a per share basis. So that's why it's only $1.83. But since each of these contracts are tied to 100 shares of QQQ, you're actually going to multiply this number by 100. So in reality, when you sell this Iron Condor, you're going to take in $183 of credit. And that's because the options we're selling, specifically the 330 strike call option and the 285 strike put option, because these options are closer, or I should say because the strikes of these options are closer to where these ETF is actually trading, these options are going to be more valuable. They're going to have higher prices than the options we're buying, right? So because the 335 strike call and the 280 strike put, the contracts that we're buying, because they're further away from where QQQ is actually trading, these contracts are going to have lower prices. And so if we're selling something at a higher price than the thing we're also buying at the same time, then the overall net result is we're still going to take in money. And also just as a side note here, if you have already seen my put credit spread video or my call credit spread video, then the Iron Condor should definitely look pretty familiar. And that's because the Iron Condor is simply the combination of both a put credit spread and also a call credit spread. And in case you're curious to watch those videos as well, I have dropped links to those videos in the description of this one below. And so similar to a put credit spread or a call credit spread, the Iron Condor is also a defined risk strategy, meaning in the worst possible scenario, right, even though we want QQQ to just stay in a nice range, that definitely may not happen. And so in the worst case, if QQQ just skyrockets, or if it totally crashes, you can only ever lose a specific finite amount of money that you have control of and that you know ahead of time before actually placing this trade. And so now I'm going to walk you through a few different scenarios here that will demonstrate this. And because the Iron Condor is a bit more complex and we're dealing with 4 contracts now, there are a lot more scenarios that could occur than with just a put credit spread by itself or with just a call credit spread by itself. So for this video, I'm only going to walk through the 2 worst case scenarios and also the best case scenario for the Iron Condor. And so that means if you do want to see all the different scenarios that could play out for an Iron Condor, like for example, what if the ETF ends up in between either our call strikes or the put strikes by the expiration date? If you want to learn about those specific scenarios, then definitely watch the individual videos I have on the put credit spread and the call credit spread. So speaking first of the best case scenario here, which is the scenario where you would actually get to keep the full $183 that you sold this Iron Condor for. And that would happen if you are correct in your directionally neutral assumption on QQQ, and it did just kind of bounce around in a nice range and ended up somewhere above 285 and below 330 by the April 16th expiration date. And so right now with the price being 308, it is currently in between those two numbers, those two prices. And so like I said, as long as QQQ ends up on the expiration day above 285 and below 330, then all of these options will still all be out of the money and they will all expire totally worthless and they will just disappear. And in that case, you will get to keep the full $183 that you sold this Iron Condor for. And just to give you a visual of what this looks like, let's go back to the charts for a second. So 308 is right here. This is where the ETF is currently trading at. And 285 is right around here. So this is the lower bound of the range. And then 330 is right around here. So this is the upper bound of the range. So as long as QQQ just kind of bounces around in this range right here over the next 40 days, and actually it could go beyond this range for a time, and so as long as by the expiration day it does end up above 285 and below 330, then as I said, all those option contracts will expire worthless, and you'll make the full profit. So that's the best case scenario. What about the worst case scenario? What if we are dead wrong on QQQ and the ETF just totally recovers and it bounces back and goes to 350 by the expiration date? So in this case, it would totally blow through both of our call strikes here. And so looking first at the 330 strike call option, this is the option that we sold. If by the expiration date QQQ is at 350, this option will be well in the money, which means the buyer of this contract, the person we sold this option to, is going to want to use this call option. Right? A call option from the buyer's perspective gives the buyer the right to purchase 100 shares of, in this case, QQQ at the strike price. So like I said, the buyer of this contract is going to exercise it so they can buy 100 shares of QQQ at a price of 330 and then immediately turn around and sell them back into the market at the current market price, in our example, of 350. And so since we are the sellers of this contract, that means we are obligated to sell those 100 shares to the buyer of this contract. And chances are, you probably don't have 100 shares of QQQ in your portfolio already to sell to this person, which means you're going to have to buy those 100 shares first and then sell them back to the person who bought this contract. But fortunately, we have the 335 strike call option that we are the buyers of. And so now as the buyer of this contract, this gives you the right to buy 100 shares of QQQ at a price of 335. So we can exercise this contract to buy those 100 shares and then immediately turn around and sell them to the buyer of this contract at a price of 330. And this will always be the case no matter how high QQQ ends up by the expiration date. Even if this ETF ends up at 1,000 by April 16th, because of these contracts here, you're always going to be able to buy 100 shares of QQQ at 335 and sell them at 330. And so if you were to do that, you are going to lose $5 per share. And then multiplying that by the 100 shares you're dealing with, that's going to be an overall loss of $500. But don't forget, we also took in $183 for selling this entire Iron Condor. And you will always be able to use this money to help offset any losses that you may incur. So if you lose $500 trading the ETF over here, but you make $183 from selling these contracts, that means the net result, your overall loss on this position, is $317. That is the maximum amount of money you could lose, even in the worst case scenario. And so that was the worst case if QQQ just totally skyrockets. What about now in the worst case where this ETF totally crashes? And let's say by April 16th, this ETF is trading at only $250 per share. So in this case, it totally blows through both of our put strikes. Well, looking first at the option we sold, the 285 strike put option, and considering the buyer's perspective on this contract, a put option gives the buyer the right to sell 100 shares of, in this case, QQQ at the strike price. And so who is the buyer of this contract going to be selling those shares to? Well, they're going to be selling those shares to the person on the other side of the trade, the person who sold them this put option in the first place. So since we are the sellers of this contract, that means we're going to have to buy 100 shares of QQQ at a price of $285. And if you didn't want those shares in your portfolio, then you could now just sell them back into the market and get rid of them. But if, in our example here, if QQQ has fallen all the way to 250, then buying those shares at 285 and selling them back in the market at 250, that's going to be a pretty heavy loss. But fortunately, we also bought this put option here with a strike of 280. And since we are the buyers of this contract, that gives us the right to sell 100 shares of QQQ at a price of 280. So if we buy 100 shares here at 285 and sell them at a price of 280, that's going to be a loss of only $5 per share. Once again, times 100 shares, that's an overall loss of $500. And once more, just like the call options here, this will always be the case no matter how low QQQ actually goes. And that's why this position here has defined risk. So once more, if you lose $500 from trading the ETF here, but you make $183 from selling this entire Iron Condor, then once again the overall maximum net loss is only $317. And lastly, before finishing this video here, I do want to touch on the overall probability of making a profit on this kind of a trade. As with all the trades that I make when trading options, I strictly use option selling strategies, and Iron Condors being one of them. And I know we're also technically buying options here as well, but if the overall result of putting on this kind of strategy is you taking in money, then you can still categorize this kind of strategy as an overall option selling position. And when it comes to selling options, you'll be able to give yourself a much higher chance or probability of making the full profit on the trade, right? Because unlike stock, where if you buy stock or sell stock, the only way you can make money is if you are directionally correct. If you buy stock, the price has to go up. If you short sell stock, the price has to go down. And there's no other way to make money besides that scenario. With the Iron Condor, as long as QQQ stays within a pretty wide range, anywhere within that range, by the expiration date, you still make a full profit. And so specifically, if we are selling the 330 strike call option and buying the 285 strike put option, what is the chance or the probability that by the expiration date, QQQ ends up either below or above either one of these options? And the cool thing with options, based on the way they're priced, you can actually back out what's called the implied volatility from the prices of these options and figure out roughly the percentage chance that QQQ actually ends up above 330 by the expiration date or below 285. So for 330 here, the chance that this option ends up in the money, which means that QQQ ends up above 330 by April 16th, is only 18.5%. And moreover, looking at the put option now, the chance that this option ends up in the money or the chance that this ETF ends up below 285 by April 16th is only 27%. And so now the way you figure out the chance that QQQ stays in between those two strikes is you simply add up the two probabilities. So 18.5 plus 27 is 45.5%, and then you just subtract that number from 100%. So 100 minus 45.5 is 54.5%. And so that is the probability as of right now that by the expiration date, QQQ ends up somewhere in between 285 and 330. And if that happens, like I said, you get to keep the full amount of money you sold this Iron Condor for. Now, a 54.5% chance of making the full profit isn't super high, but the cool thing with options is you have complete control over your chance of success, and also, with these defined risk strategies, how much risk you're willing to take on. So if you want a higher chance of making money on this trade, then you can just widen out the strikes, right? Instead of selling the 330 strike call option, maybe you want to sell the 335 strike call right here, and then buy the 340 strike call option. And then for the puts here, maybe instead of selling the 285 strike put, you now sell the 280 and buy the 275. And this will now give you a much higher chance of making a profit or making the full profit, right? The 335 strike call option is here, only a 13.25% chance of this option being in the money by the expiration date. And the 280 strike put option is right here, now only a 23% chance of this option being in the money by the expiration date. So once more, taking 23 plus 13, and I am rounding a bit here in this case to make the math easy, that gives you 36%, and then subtracting that from 100, 100 minus 36 is 64%. So now by moving the strikes further away, you have given yourself a 64% chance of making the full amount of money on the trade. Now there's always a give and take with this kind of thing. You can't just give yourself a higher chance of profit and make the same amount of profit. So in this case, the overall credit is now only about $140, but now you do have a higher chance of keeping this amount of money. And lastly, if you want to risk less money in the worst case scenario, then you can just make the difference in strikes between the call options and the put options more narrow as well. So instead of buying the 340 strike call option, maybe you buy the 338 strike call, and then instead of buying the 275 strike put, you buy the 277 strike put. So now the width of the strikes on both sides here is only $3 wide. And once more, obviously, the credit you receive is now much smaller, right? There's always a give and take with this kind of thing. But now you have a 64% chance of keeping this full amount of money. And in the worst case, if you are dead wrong and the price of this ETF totally blows through your call or your put strikes here by the expiration date, the worst case scenario is you only lose $211. So I know we covered a lot in this video, and I threw a lot of information at you, so of course if you've got questions or if you need clarification on something, please ask away in the comments of this video, and I'll get back to you as soon as I can. And so that concludes this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some in-depth classes on options trading, and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And lastly, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel, and make sure those notifications are turned on. I'll be dropping new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.